Good day, everyone. Welcome back to the weekly mentorship outlook. Right. This week we will be focusing heavily on Euro USD. Right. That's our main focus on this mentorship video. So yeah, I'm gonna upload this also to YouTube. And if you're not in the mentorship group and there's stuff that I mentioned that you don't understand or you might need a bit of explanation, just comment on the video and I'll respond here. Right. So yeah, the broader narrative of US dollar and also the macroeconomic developments that continue to shape the institutional position across the forex market. So basically that's what we are going to be focusing on heavily, right? Number one, Euro USD. Number two, the broader US dollar narrative. Number three, the macroeconomic developments that that continue to shape positioning across the whole of the FX market, right? So the core outlook remains bullish on Euro USD, which aligns with the broader bearish dollar forecast that I've already shared with the mentorship group. So if you haven't watched that video, you can go onto the channel. You can see a detailed analysis of a bearish dollar in the coming 2, 3, 4 months or up until end of year, right? So now before we go into technical expectations, which is what most people always come for when they're looking at this forecast video, they want to see what's happening on the chart, right? But before we go into that, it's important that we first understand the macroeconomic narrative that's driving this market, which is Euro USD, right? We have to understand the narrative driving this market, because higher time frame moves are never random, guys. Take note of that. Higher time frame moves are never random. They're driven by capital flows, central bank expectations, inflation dynamics, and investor confidence, right? So just a rough guide. This whole move that we've seen on Euro USD since last year, Feb, it has been driven by certain aspects of the markets, right? There's things that you have to understand as a trader in defining that whole move to the upside. So regardless you go onto the weekly, regardless you go onto the daily, right? If the narrative is bullish, like what we've already done from last week, we can see Euro pushed to the upside. I think we only had a strong bearish day on Monday, of which we hardly get into positions on Monday. That's our day to map out our weekly profile, right? So understanding the macro narrative driving a market is crucial, right? It's very important. So I've mentioned capital flows, I've mentioned central bank expectations, I've mentioned inflation dynamics, and also investor confidence, right? So from a macro overview, looking ahead into the week, right? Going into the new week, geopolitical tensions in the Middle East remain a major driver for global markets. We cannot ignore what's happening in Middle East. Even though the United States and Iran announced a ceasefire agreement, tensions remain unstable throughout last week and the week before that. And markets are still sensitive to any signs of escalations, right? Markets are very sensitive to that. This matter because geopolitical uncertainty directly impacts risk sentiment, commodity price, inflation expectations, and ultimately the US dollar index, right? So we have to be on our toes in understanding what's going on. Also, alongside geopolitics, markets will also be closely watching several US economic releases, right? Which brings me to the calendar, right? Let's take a glance of what's coming in the week. So Monday is more or less a quiet day in the markets in terms of fundamentals. Yeah, we do have existing home sales, that's month on month. Then we do have existing home sales for April. That's already deep into New York session. We also have inflation news for coming for China, right? Then on Tuesday, yeah, we do have a couple of important fundamentals, mainly inflation news for the United States, which is what we have to focus on, right? Consumer inflation data, producer inflation data, retail sales, industrial production. And then we've got quite a few Federal Reserve speeches. So for Tuesday, we've got inflation data coming in from the United States. And then for Wednesday, we do have crude oil inventories. We also have PPI, producer price index. That's another inflation data. And then on Thursday, we've got you can see I'm focusing mainly on US data because that's the one that's very important when we look at the narrative that the markets are pushing at this moment in time. So Thursday, we do have retail sales, all right? We do have retail sales on Thursday. And then we're going to finish the week with the New York Empire State Manufacturing Index, though it's not that much of a high impact news, right? So I also want everyone to pay attention to the political side of the market, because on May 11, right, which is going to be tomorrow, on May 11, the US Senate is expected to vote on invoking a cloture regarding Kevin Warsh's nomination as the new Federal Reserve chairman, right? So he's the guy who's gonna, I think it's almost done, he's gonna replace Powell. So there's no more Powell. There's no more Powell in the markets, guys, but they are more or less the same man. It's just that I think Welsh is gonna push a narrative that is more aligned to Trump, right? Now, why is this important? Because markets are forward thinking, right? Markets are forward looking. They're constantly trying to price in what future monetary policy could look like. And any shift in leadership expectations at the Federal Reserve can influence interest rates expectation, bond yields, and ultimately the direction of the dollar. So it's key that we understand what's going to happen tomorrow, right? Now, looking at the real driver behind dollar weakness, just a summary of what I spoke about last week, right? Looking at the real driver behind dollar weakness. Let's go to DXY. Let's use the weekly chart. You can clearly see how we are moving to the downside. I already have the levels from last week marked, right? So the real driver behind dollar weakness, the real yields, right? One of the biggest mistakes retail traders make is assuming that higher interest rates automatically mean a strong dollar, right? Higher interest rates automatically mean a strong dollar. That is not always true. What truly matters is real yields, not just nominal interest yields, right? We are talking about the United States inflationary rate. We are talking about United States interest rate. So I'm just going to display these two charts here quickly so that you guys can see and also be in a position to follow through. Now remember, you don't use these charts on a daily basis. You probably notice that their time frame only starts from higher time frame. So these are the United States interest rate chart, right, which is sitting at 3.75 for the past 1, 2, 3, 4, 5 release. You can see there the Fed has been cutting rates, but lately rates have been unchanged, right? Then you also need to follow through with the United States inflation rate, mainly the year on year, right? So these two charts are very important, guys. These two charts are very important. You can see there our year on year inflation rate is sitting at 3.3. Right now the Federal Reserve is maintaining a relative steady policy stance, but inflation pressures remain elevated. Remember the Fed's mandate. Take note of the Fed's mandate. I'm not gonna be going into detail with that, but understand it, why the Fed is there. Their target for the inflation rate is 2.2. So you can see there how inflation shot up. I think from last beginning of March, inflation shot up from 2.4 to 3.3, right? That's concerning. That's concerning. You see, that means inflation pressures remain elevated. What this means is that inflation is not cooling fast enough relative to interest rates. So those two charts that I displayed, this chart including the other one, the United States interest rate, they're not cooling fast enough, right? So even though nominal rates remain high, the real return investors receive after accounting for inflation is becoming less attractive in the United States, and that is extremely important, right? Global capital does not chase nominal rates alone, right? Global capital, we're talking of big guys here, people who invest big funds, right? Institutions, they care about inflation adjusted returns, risk adjusted returns, right? Relative yield attractiveness compared to other economies. Those are the things that institutions care about, right? As US real yields begin to compress, right, international investors gradually lose incentive to aggressively hold dollar denominated assets, which brings us to dollar bearish, right? I'm not going to go into detail, but you can already understand from what I'm explaining why we are leaning towards a bearish dollar, right? So as US real yields begin to compress, right, investors gradually lose incentives to aggressively hold dollar denominated assets, right? That creates structural pressure on the dollar, right? At the same time, the Eurozone is beginning to look relatively more attractive, you see, which means bullish for euro against dollar. Markets are increasingly expecting the ECB to maintain tighter policy conditions while inflation across Europe begins to stabilize. Even if European real yields are still relatively low, historically, the direction itself matters, right? Markets trade direction and expectations more than absolute numbers. So while US real yields are deteriorating, European yields expectations are improving, relatively speaking, and that supports euro strength. See, this whole narrative, guys, in understanding this whole narrative helps you in making better decisions when you're trading. You're not going to go blindly into your trades. Yes, there is indicators out there. There's a whole lot of things that people use, right? But you as a trader, you need to understand what you're doing, how you're making that decision, what's leading to you shorting dollar, what's leading to you going long on pound USD, right? That way you only doing good for yourself because you're enhancing your chances of a high probability trade setups, which then intend to good results. So in continuing, right, why falling US real yields matter for Euro USD? Why do they matter, Ivan? Why do we focus on the US real yields, right? When US real yields decline, several things usually happen simultaneously. Number one, gold becomes more attractive, right? Gold becomes more attractive because the opportunity costs of holding non-yielding assets decreases. So don't be surprised if we start seeing gold making a recovery towards 5,000 or 5.2 heading towards 5.4, right? Number two, capital begins rotating into risk assets such as equities and higher beta currencies, right? Talking of AUD, NZD, pound, yen, CHF, CAD, all those currencies. Number three, the US dollar slowly loses its attractiveness as a yield-driven safe haven. This is why we are seeing a broader diversification away from the dollar and into assets like gold, euro, risk-sensitive currencies, Swiss franc. I say risk-sensitive currencies like Swiss franc. I'm not going to talk about crypto as part of the broader diversification, right? This is not just a technical move. This is global capital reallocation, right? And that is why higher time frame trends can sustain themselves for weeks or even months, right? So basically what I've been explaining here is a narrative that is supporting bullish directional bias on euro. We are heading for $20 on euro, $19, $20 for those in the group who are looking for swing setups. Unless something drastic happens in the Middle East, unless a surprise happens tomorrow with the Senate, but for now, our forecast for euro is heading towards the $19 and the $20 price points, right? Now, we just need to address a small elephant in the room shortly. NFP breakdown, what we saw on Friday. Now, looking beyond the headline, right, that number that we saw on Friday, let me just go quickly to the chart. Let's go to the chart. NFP. Let's see. So this is, so we need the 8th. We just need the 8th there. It was a positive release, but in terms of what it means, so NFP, these are private non-farm payrolls, came in at 115k. Forecast was 65. Previous release was 185. I thought that was 178. Okay, be that as it may. Yes, it is a positive number, but let's talk about it in a brief, because many traders only focus on the headline number without understanding the quality of the data underneath, right? So the April NFP report showed that the US labor market remains resilient on the surface, guys. Take note, on the surface, on that number that we saw. However, when we dig deeper into the report, we begin noticing the job creation is becoming increasingly concentrated in defensive sectors such as healthcare, social assistance, rather than cyclical growth sectors like manufacturing, technology, and industrial expansion. So some might start asking now, oh, Ivan, where do you get those numbers? Right, you get those numbers from the US Bureau of Labor Statistics, right? This is where you get the NFP release in detail. I already have it open here. I'm gonna share with you the link, but this is where you get a detailed release of NFP. So I've already done my weekend analysis, and that's why I'm coming up with all this report here. So we can clearly see that the sectors that are becoming increasingly concentrated are just defensive sectors, which don't really make much of a huge difference in terms of what the Fed needs to see in achieving maximum employment. I made a screenshot quickly so you can see here the biggest job creation sectors. We've got healthcare, we've got the transportation and warehousing, servicing, then we've got social assistance, you see, retail, trade. But healthcare and social assistance, those are your defensive sectors, right? Rather than cyclical growth sectors, which makes these sectors, they make huge difference. We're talking of the manufacturing, the technology and industrial expansion jobs, right? So this is very important, guys, because during strong economic expansion, job growth is usually broad based across productive and growth oriented sectors. And when employment growth becomes concentrated in defensive sectors, it often suggests the economy is slowing underneath the surface despite stable headline numbers, like what we saw. We had a very nice number, but it was still weaker than previous release. Look how dollar reacted to that number. Let's just go on to the hourly chart. NFP right there. Dollar kept on going lower, right? Say for instance, if those numbers were concentrated if the numbers were concentrated more in cyclical growth sectors like the manufacturing, the technology and the industrial expansion sectors, chances are very high dollar would have maintained a bullish stance heading into this imbalance here. But dollar kept on going to the downside, right? That's key. You have to be in a position to explain that, right? This is why I said this is not the type of jobs report you usually see during a powerful economic expansion, right? So yes, the report may temporarily support the Federal Reserve wait and see approach, but medium term, the declining quality of labor market growth combined with the weakening real yield attractiveness could become a headwind for the US dollar. Dollar could push to the downside big time, and naturally that supports gold, that supports Euro USD, that supports risk assets overall, right? So that was the elephant in the room that I had to address. Make sure you understand the narrative behind a NFP release, and you can get more detail from the United States Bureau of Statistics. That's where you can get more detail, the analysis or releases of most of the high impact fundamentals, right? We do get a lot from these guys here. Inflation prices, you see, productivity and technology, employment projection, regional news. There is a lot, employment and unemployment. So you get detailed release from the United States Bureau of Labor Statistics. Now coming back to our higher time frame narrative on Euro USD. Coming back to the narrative of a bullish Euro USD. Now this next section is extremely important, guys, so pay attention. The next section is extremely important. Now just a quick one, right? When you're on the weekly chart for Euro USD, try to identify inefficiency where market can be drawn to before it push to the upside. Try to identify old highs, old lows, discount areas that you can go long from, right? So that you know what you are looking at. Or you can look at last week's mentorship video, right? And then compare the levels that I marked, in regards to dollar index. Then you compare them to Euro USD, right? So one thing you must understand is that higher time frame moves in Forex are rarely short-lived. Once a macroeconomic narrative becomes established, trends can persist for a very long time, right? The market does not suddenly reverse because of CPI release or a speech from a Fed official. A true trend reversal requires consistent inflation changes, economic deterioration or acceleration, central bank communication shifts, changes in rate expectations, capital flows adjustment. These are things that matter when you're looking for a trend reversal. So in other words, the markets needs confirmation, not noise. And this is where patience becomes critical. Not every environment is tradable. Not every environment is tradable. Sometimes narratives are unclear and conflicting, and during those periods, price action becomes choppy, like what we saw with the NFP number. Price action became choppy after the release, or it becomes inefficient and low probability. As traders, one of the most professional decisions you can make is choosing not to force trades during uncertain environments. Sometimes the highest quality trade is not trade at all. Capital preservation is part of professional trading. Sitting on your hands is also a position. Don't force trades, guys. You don't need to force trades if there's no narrative. Why am I saying all these things in a weekly focus video? Is so that you understand where I'm coming from in terms of how I came about looking for a bullish dollar, right? Now let's look at some historical context so that we understand the macro cycles, right? Let's connect the dots historically, because understanding previous cycles help us understand where we currently are, right? So we're going to go back to say May 2021 to September 2022. This is just from COVID into after COVID. This is where we had an aggressive Fed tightening dominating what? The markets, right? During this period, inflation surged globally to multi-decade highs, right? Let me get my inflation chart here. Let me get my inflation chart. Get my inflation chart so that you can see what I'm talking about. So you can see here from May, so this is Jan, Feb, March, April, that's May 2021, right? Where the inflation sitting at 4.9, basically 5, right? And then it surged all the way to 2022, June 2022, right? Surged all the way to 9.1, right? This is when we had an aggressive Federal Reserve tightening, right? The Federal Reserve responded aggressively with rapid interest rate hikes, while the ECB remained slower due to structural weakness within the Euro zone. That divergence created a massive yield advantage for the dollar. What was the result? A strong USD appreciation, right? So you can see there from 2021, let's go to DXY. From 2021, we had a strong dollar, right? You can see there, May 2021, dollar traded into discount, and the rest was history up until October 2022. And we had a sustained Euro USD downside right here. May 2021, Euro USD went all the way to below parity. I remember we focused at parity on Euro USD during that year, right? Then September 2022 to May 2023, inflation peaks in the US, right? As US inflation began slowing, markets started expecting the Fed to slow down tightening, right? Meanwhile, the Eurozone began slowly. Eurozone inflation remained elevated, right? This caused markets to anticipate continued ECB tightening, and we can see while the Fed approached a pause, that narrowing policy divergence allowed Euro USD to recover aggressively high. You can see there from September 2022 up until May 2023, we had Euro USD aggressively move to the upside. Then September 2024 to January 2025, political risks returns. Markets began pricing in the possibility of Donald Trump returning into office, right? So we're talking of September 20, where we right here, September 2025 to January, September 2024. Where is September 2024? Right there. Market began pricing in the possibility of Trump coming back into office. Tariff expectations introduced inflation concern because tariffs increases import costs and disrupt supply chain, right? This initially supported the dollar because markets anticipated potentially more hawkish Federal Reserve. Then from March 2025 to June 2025, March 2025 to June 2025. So we're talking of this bullish move that we saw here, right? Up until now, this is on Euro. March 2025 to June 2025. This is where we had a tariff shock right here. This is where we had a tariff shock and then dollar weakness, right? I've already mentioned what tariffs does. They increase import costs and disrupt supply chain. That affected dollar big time to the downside. This is where things became very interesting. The aggressive US tariff environment created uncertainty around global growth, around trade stability, around supply chains and capital flows, right? Instead of strengthening the dollar sustainably, markets began diversifying away from the USD exposure, right? At the same time, the Eurozone introduced large-scale fiscal and policy supportive measures, what many participants called an inflation bazooka, right? This signaled a far more coordinated and proactive European response. That combination weakened the dollar. We can see there March 2025 all the way to June 2025, right? That combination weakened the US dollar, improved confidence in Europe, and supported Euro USD to the upside. And if you go there, Euro USD moved aggressively to the upside, right? Now going into this week, guys, right, having addressed these historical patterns, the reason why I've mentioned that is so that you understand where we are going with Euro USD, right? Going into this week and potentially the coming weeks, months, dollar is beginning to resemble the same broader behavior we saw during Trump's first term. We are seeing extended consolidation, brief geopolitical premium spikes caused by Middle East, right? Failure to sustain upside momentum. You can see there during February, markets struggled to sustain upside momentum. We went above 100, but we couldn't sustain that higher price. And again, the core issue is not nominal rates. The core issue is not nominal rates. It's the real yields. If inflation continues rising faster than bond yields, the real rates continue falling. And when the real rates fall, the dollar weakens, even without actual rate cuts. This is something many retail traders fail to understand. The dollar is not strong simply because rates are high. The dollar is strong when US real yields are attractive relative to the rest of the world. And right now, that advantage is slowly deteriorating, right? So, in a nutshell, the overall bias on Euro USD, the higher time frame outlook continues favoring Euro USD upside move. As long as US real yields remain under pressure, as long as the Fed stays relatively paused, which is something that might change if Walsh comes into the office, because I can see this guy doing whatever Trump wants him to do, because right now Trump is like, guys, you need to cut what rates. As long as European expectations stabilize, as long as capital continues diversifying away from the dollar, we have to be focusing on a bullish Euro USD, right? So basically, Euro USD remains fundamentally supported. Of course, there'll still be pullbacks, corrections, and volatility throughout the week. As long as we have all those fundamentals lined up on the chart, there will be pullbacks, there'll be corrections, there'll be volatility throughout the week. It cannot just go up, but identifying where you can go long into the market is key, right? You can see here, that's our bullish OP. Then we've got inefficiency here, area which has not been traded too efficiently. That's a fair value gap right there. You see, those two price points, if price is to correct or retrace to the downside, these two levels, price should find support as the week goes, targeting probably previous week high, right? If we do get a retracement into that level, if we go to say on an H4 time frame, you can clearly see this whole imbalance here. Price can open, fill up that whole inefficiency there, and find support for a move to the upside. So how price reacts when we are in this zone here is crucial, right? Unless the macro narrative materially changes, unless if the broader directional bias changes, right, Euro USD remains bullish and dollar index remains bearish, right? As always, guys, don't focus on predicting every candle. Focus on understanding the narrative driving the market. Because when you understand capital flows, when you understand central bank expectations, real yields, inflation dynamics, you stop reacting emotionally to short-term volatility and begin trading with macro alignment, right? These are the things you have to know as a trader, right? So yeah, that's pretty much for this week. It was more of a theory than practical, but that theory is important in you understanding the markets. So yeah, that's pretty much for this week. I'll be popping in here and there with other nuggets for you guys. As of now, kindly, please guys, trade safe, remain patient, and I'll see you in the next mentorship session. I wish you nothing but the best and good luck. Thank you.